Well, it's safe to say 2020 has been a wild ride for stocks. From late February, we saw global stock markets plunge in what was the fastest fall to a bear market in history. But fast forward a few months later, and stocks are rallying in what is now the quickest recovery we've ever seen. But with COVID-19 sending the world into recession, is the market behaving rationally?
We're at the end of yet another month, and it's been a good one for markets around the world.
It is another bad day on the market.
It looks like the stock market crash is over. Or is it?
We are living through the worst economy that almost anybody alive has ever seen.
I spoke to fund manager and author Roger Montgomery of Montgomery Investment Management to better understand why the market has been so wild and whether now is the time to start investing or if we should all just take a pause.
Well, it's pretty obvious that markets were expensive before COVID-19 hit. So we had record high price to earnings ratios on the S&P 500. We also had record high price to earnings ratios for the ASX 300. And that was despite the fact that earnings estimates for next year were actually declining.
Quick note, price to earnings or P/E ratio is used to work out whether a stock is overpriced or underpriced. So if a stock has a high P/E, that indicates it might be expensive or that investors are expecting its stock price to rise.
Despite that decline in earnings estimates, the market was going higher. In other words, people were ultimately willing to pay a lot more for less. Now, that's an unsustainable scenario. And then, of course, we had a retail recession in Australia. We also had a 40% decline in new residential housing approvals, which is obviously a leading indicator for housing construction. The construction industry is the third largest employer in the country. And so if you have a retail recession, retail is the second largest employer in the country, and you have a residential construction recession, then you're going to have a recession in Australia. And then we had COVID-19. So that was the icing on the cake.
So it seems like there are a number of factors that led to this fall. But what about the massive rally we've seen in the last month? I asked Roger if the recovery is here to stay.
So the expectation clearly is for a V-shaped economic recovery, and that is irrational. Now, what the market is doing is focusing on government fiscal support, and it's focusing on central bank liquidity support, which has been in place since the GFC.
One support measure is the Fed has offered to buy up leveraged loans so that companies are able to repay their debts at lower interest rates than they'd normally be charged by the banks or other financial institutions.
When the Fed is buying those CLOs, it keeps the interest rate on the loans cheap. But what it doesn't do is it doesn't give those businesses any revenue. So in fact, if you boil it all down to a really simple difference, the stock market's definition of recovery is different to what yours and my definition of recovery is. The stock market defines recovery as anything better than the bottom.
We've often heard the line dead cat bounce this year. This is where a stock market falls only to temporarily recover before it plunges even further. The big question now is, will the market crash again?
It ultimately depends on whether or not companies are able to deliver on market expectations for earnings. I don't think all of them will. I think some of them will. Some of them will exceed expectations, but plenty won't. So we've got unemployment at about 6.2%, but that recent April unemployment figure includes everyone on JobKeeper. They're being counted as having had a job in April, even though they might not have worked a single hour. When JobKeeper stops, when rent relief stops, when the anti-eviction rulings stop, when mortgage holidays cease, when all of that stuff stops, there's going to be a lot of people who think they're going to go back to their job and that job won't be there.
Since the market correction started in late February, we've seen record numbers of new investors jump into the stock market to take advantage of low stock prices. In Australia, 4,000 people a day opened share trading accounts between February and April. But with volatility at all-time highs, and some analysts predicting another crash, is now the time to invest in stocks?
Well, if they're young, they've got a very long time horizon. And so you don't need to worry about the small amounts that you're investing today. If it halves today, so what? Just buy more, provided you're investing in qualities. The other thing I think people should be wary of is the period between September and November. And the reason why I say that is because that's when all of that assistance is potentially going to end. Now, it might not end, but if there's any fear that some of those support programs are going to cease, then that could result in a lot more volatility in markets. And volatility is something to be excited about. Volatility is something to look forward to, because you really should be buying stocks the way you buy blueberries. When they're $9 a punnet, I don't buy any. Right? But when they're $4 a punnet or $4.50 a punnet or $3 a punnet, I load up and we freeze them. And that's the way you should be thinking about buying stocks. When it's cheap, buy a lot more. When it's expensive, don't buy any.
With shifting global power dynamics and countries still in lockdown thanks to COVID-19, we're going through a pretty uncertain period at the moment, and no one can say 100% where the stock market will be in 12 months' time. But history tells us that even during times of major unrest, such as war or depressions, the stock market will eventually recover. And it's up to you to decide where you'll be sitting when that happens. We'd love to hear from you, so let us know in the comments where you think the stock market is headed. And to listen to the full version of the interview with Roger Montgomery, head over to the Pocket Money podcast via the link below. To learn more about investing or to find out how to get started, we've linked a number of resources in the description.